I'm here. It's I guess
Welcome,
there's no
Paul.
way to freeze the who's on video, but it's WebEx. So not okay.
Yeah.
Anyway, I'm here.
Okay. Well, welcome, Paul.
There.
And welcome to all of you to our IEO webinar. We're going to be discussing inflation's takeoff, whether it's transitory or troubling or both or neither. We're going to start with the conversation with Paul Krugman and then bring in for the roundtable discussion, Larry Ball, Surjit Bhalla, and Sonali Das. So Paul, thanks very much for making the time for this. I won't give Paul an introduction, only note that his blog and his writings have always played a big role in shaping opinion at the fund. I was a fly on the wall in the research department at the start of the global financial crisis, and I could see the influence that Paul's blog, The Conscience of a Liberal, was playing in shaping the debate within the IMF. And so I think having Olivier Blanchard on the inside and people like Paul Krugman and Larry Summers on the outside really was a formidable team helping guide fund opinion. So I think we are at a juncture again where we are turning to folks like Paul for guidance. But at the moment, our gods are a bit splintered with Paul on one side and Summers and Blanchard somewhat on the other. So Paul, let's start with your November 14th tweet, where you said, I got inflation wrong. I didn't see the current surge coming. Can you sort of tell us why you had reached that conclusion, what has happened since, and where you stand now? Are you still sort of the captain of Team Transitory, or are your views starting to shift?
Okay, so I guess Chairman Powell told us today that the use of the term transitory is just a passing fad. So anyway, all right, let me describe where the debate was. I think I find it helpful to think of it kind of in terms of how this has unfolded, where the debate was early this year and what has happened. This is a debate where people on either side are not stupid and not crazy, which is unusual these days. Early this year, we had in the United States the American Rescue Plan, which was a lot of money. And so one side of the debate, Larry Summers, Olivier Blanchard, looked at the scale of it and said that is a huge amount of fiscal stimulus and will push the economy far above potential and lead to a lot of inflation. People like me took a look at it and said, yeah, that is a whole lot of money, but it's probably very low multiplier. Things like aid to state and local governments will not be spent rapidly. A lot of the checks to individuals would probably be saved, and it would probably be a low multiplier event and wouldn't overheat the economy that much. What actually happened, at least as I read it, is that the low multiplier analysis was correct. That in fact, if you look at final demand, if you look at C plus I plus G, it's up about 4% over the past 2 years, which is roughly in line with the normal growth of potential output. However, the economy looks overheated and inflationary. So in some sense, neither side has been right about how the story would play out. We've actually had the low multiplier story, but we've had the inflation, and I think basically nobody should be doing a victory dance in the end zone here. It hasn't come out the way anyone expected it to. My read on what's happened, which I thought was uncontroversial, but I've gotten some slightly hysterical pushback from some people on the other side of this debate in private. But anyway, is that we've run into supply constraints that probably we should have seen come, or some of them we should have seen coming, but we didn't. I think there are actually two quite distinct supply constraint stories. One is the supply chain stuff that we all talk about. And the other is the Great Resignation, the surprise drop in labor persistence of low labor force participation. The supply chain stuff is very much about the composition of demand, the extreme skew towards goods as opposed to services, and durable goods in particular. And the numbers are really kind of eye-popping, right? At the peak, it's faded a bit, but at the peak, durable goods consumption was 34% above pre-pandemic levels. So no wonder we have a problem with the supply chain. That we should have seen coming, but we didn't. I mean, just it's a little bit like shadow banking. Once we understood what was happening, it was obvious, but it wasn't obvious in advance. The other is the Great Resignation, and that has really been mind-boggling. So we're still 4 million down from pre-pandemic employment in the United States, but all indicators are now pointing to a very, very tight labor market. Okay, where I am now, the supply chain stuff should fade. The labor market stuff is very much up in the air, but the question has got to be, does this a one-time overheating of the economy, whether it's because of demand or supply constraints, has historically not translated into sustained inflation. It takes a long period of, at least in the past, it's taken a long period, year after year of an overheated economy to get into something, for it to get embedded in expectations. And so that's where I am right now. I still think that this looks like, well, we can talk about historical episodes, but that's where I am now. It's that this has not played out the way anyone expected, but it's not yet at the point where you want to say, hey, we have a fundamental prolonged overheating that is feeding into expectations.
Right. Yeah, so maybe let's talk about the kind of historical episodes that we could look back to try to guide us about what might happen in the future. You know, folks of my age certainly worry about a replay of the 1970s, and that's what Martin Wolf said in a FT article. He said we are making the same errors now. So I think that is the worry on the minds of many who've lived through the 70s. Is that the right experience, historical experience to draw on, or are there others we could be guided by?
Yeah, I mean, I'm also, I'm actually, I have I'm putting together a longish piece on inflation, probably to be published in the Times, and I start with Hamburger Helper, because I was a student living on a limited budget, and ground beef prices had gone crazy, and meat extenders were a big part of life. So the thing is, okay, I thought it was a terrific insight by the CEA, the Biden CEA, that said that we really should be looking at the 46 to 48 inflation after World War II, which was remarkable. CPI growth hit 20%, and stayed really elevated, stayed in double digits for almost 2 years. And it was clear that was clearly a demand pull inflation. It was a huge pent up demand for particularly for durable goods after wartime rationing. But it did not. What was striking about it from modern perspective is that when the demand subsided, inflation fell quickly. The inflation did not get embedded into the economy. There was no stagflation following that. This so far looks like that. It looks like an economy that hasn't restructured to meet the changes. In this case, it's because of the pandemic. That time it was because of trying to convert a wartime economy back to peacetime, and a burst in demand. Although in this case, actually, the overall demand, as I said, is not all that high. But given the apparent supply constraints, there we are, and that seems like a more likely model. What we're all worried about, of course, is does this get embedded in inflation? Do we get a situation where this kind of leapfrogging process that is what kept inflation going during the 70s, even during recessions, gets reestablished? I would say that there's but no one, if you're sure about what's happening, then you're not paying attention. But I would say that given what we see so far, what happened in the 60s and early 70s was year after year of indifference to inflation. It was the Great Society plus Vietnam War, which went on for years. Then a brief anti-inflation policy followed by politicization of the Fed and Arthur Burns generating a runaway boom to get Nixon reelected. It doesn't seem, at this point, the inflation story is about 7 months old. That does not seem like enough to get it really burned into people's expectations. But obviously, if you're not, you have to be worried. But there's a reverse mistake too, which is if we I mean, at this point, the action is all in monetary policy. In a way, the fiscal policy thing is all a debate about stuff that is in the rearview mirror and is a bygone. If we tighten monetary policy, what if it turns out that you're tightening monetary policy just as the fiscal impulse is fading away, and the economy is reverting to what appeared to be its normal state pre-pandemic, which was secular stagnation? You really don't want to be doing that. So it's not an easy call right now, but I would say that there isn't remotely enough evidence in there to pull the trigger on rate hikes. But that is the question.
But I mean, your mention of Great Society made me think of another sort of theme that's out there, or some concern that we are passing Build Back Better and sort of the equivalent of the Great Society bills right now. Are you not worried that this would also play the role that the Great Society programs did in the 60s?
No, not really, for two reasons. One is Build Back Better is really at this point it's not actually all that much money. It's I mean, it's not quite right to just do decade analysis, but I think it's close enough that we have a CBO projection that cumulative GDP over the next decade will be 288 trillion, and you have a 1.75 trillion spending plan, which is largely, not entirely, but probably largely paid for with tax hikes, and even if you include the infrastructure, which is kind of odd given the way people talk about these things, the infrastructure bill is basically paid for with smoke and mirrors, whereas Build Back Better is largely is pretty close to paid for. But the two of them together is um, still well under 1% of GDP, largely paid for. It's just not that much fiscal stimulus. So I think that is not the real issue. It's just not. There's no plausible set of parameters under which spending on that scale or deficits, net fiscal stimulus on that scale would make a significant difference to any of this.
So let me ask you a little bit more then on what precisely you would want monetary policy to be doing. You say you're worried about the reverse mistake, so I take it you wouldn't agree with Martin Wolf's position on this, which I think he said something like the current policy only makes sense in a depression, and we're not in a depression.
That's a good. I somehow I missed that column. But what I would say is actually, for the past, in a lot of ways, in a functional sense, we've been in a depression since 2008. In the sense that the zero lower bound has been, if not actually binding, at least close to binding. We're basically, if we're in a secular stagnation world, which I think we are, or we were, and I see no reason why we won't be once COVID becomes, I don't think it goes away, but once it becomes part of the background noise. In that kind of world, you're always in a situation where aggregate demand is consistently a problem, and the possibility of not having at hand the tools to provide enough demand is always lurking. And so I think that it's an area in a way. A couple of years ago, there was a lot of discussion about how we should be running persistent stimulative fiscal deficits being advanced by a guy named Larry Summers, right? And I think that argument still holds, that that's likely to be, by 2023, we're likely to be back in that world. And so that's why I mean, I'm not sure I know why we should still be doing QE at this point, but in terms of should we be doing major retrenchment? And again, I think I saw flashing up there in the chat, why is fiscal policy
right
rearview mirror? The reason is, in the United States, there is nothing's going to happen. I mean, it shouldn't be necessarily in a principle in terms of fundamental economic principles, but realistically, do you think that there will be a new spending bill beyond Build Back Better? Do you think there'll be a new tax hike? We're likely, if anything, I mean, the most likely outcome is of the political process is going to be divided government. And even if that doesn't happen, we effectively on fiscal policy have three parties, which is Republicans, Democrats, and Manchinima, and since that third party has veto power, we don't get anything. So, and that's just in general. Fiscal policy is very hard to do in the modern political constellation. So it really is all about monetary policy, and the Fed does not want to, or I would say the Fed should not be, has to always think in terms of what policy choices will be very difficult to undo later. And unfortunately, that applies on both ends. If inflation becomes embedded, of course, that's painful to undo. But if stagnation gets embedded, that's also very difficult to undo. And there are really risks on both sides.
So, I mean, now hearing you and reading what Larry Summers has written about what he thinks the Fed should do, I'm not sensing a huge difference. I mean, Larry says there should be accelerated tapering of the asset purchases. I think I heard you say that's okay. Larry said you should stop mortgage-related purchases given the housing price boom. Would you go along? I mean, would you sort of go with that? Are we talking now nuances about the pace at which this should happen rather than a disagreement over policy?
Well, I'm finding it a little bit hard to know exactly. Larry, actually, I'm engaged in a lot of discussion publicly and back channels with Jason Furman, who is in some ways the most the sort of least public profile, but fairly high. But and there seems to be, on asset purchases, it's really not. It is hard to see why we should be doing this, because the issue that's on the table that matters is actually conventional monetary policy. Should we have a rate hike? And since that is a real possibility, I can imagine, I would put it as the less likely outcome, but it's certainly possible that sometime in the next 6 months there might be data that would make it clear even to Team Transitory that it's time to have a rate hike. Be embarrassing to be engaging in long-term asset purchases at the same time that you're raising rates. So it's not clear to me why you should be doing that, except that I think they just don't want to do anything suddenly. I think the best justification for continuing this is just not to have a sudden stop in the program. But as best I mean, it is interesting. I don't think that Larry or Olivia or Jason have actually said definitively we should raise rates now. I don't think anybody said we should raise rates now, and they haven't even definitively said that we should raise rates by March or April. But there seems to be, it's more a difference really about what are the data that would, or what should be your presumption, and that is tricky actually. It's
so maybe that's
I put the presumption, I put a presumption of innocence on inflation. And I think they would put a presumption of guilt, but it's still, it is more nuanced than one would like, given the amount of heat in this debate.
So maybe we can end on that note. I mean, what indicators are you looking at to judge your position and calibrate your position? And what would it take for you to say, well, inflation now should be our central concern?
Yeah. So what I'm looking for is any hint that inflation expectations are starting to get embedded in price and wage setting, which is unfortunately that's really hard to measure because we don't. We have a direct measure of inflation expectations from the bond market, but for what it's worth, the bond market is still on Team Transitory, but that's the bond market doesn't set wages and prices. We have consumer expectations of inflation, but we know from lots of of evidence that when you ask consumers, what do you expect inflation to be, they actually respond by talking about what the price of gasoline is. So it's consumer expectations are not actually very helpful. So you're looking for subtler clues about uh, how inflation, whether anybody is raising prices not because demand is high or supply is constrained, but because they expect everybody else to be raising prices. So you read the beige book. It would be great. Actually, Joe Wiesenthal from Bloomberg had a very good suggestion just today that we really should have an ongoing survey of workers in addition to all these surveys of businesses. And we should have a beige book like thing where they talk to 100,000 workers instead of a few thousand businesses. But we don't have that, and it's not clear it would quite give you what we want. But so you're looking for clues that this is happening, and it's. I mean, part of the problem is that the thing that we're so worried about, which is on the inflation side, which is embedded inflations, we worry about how the expected rate of inflation might be rising, and I'm not clear that there even is really anything such thing as an expected rate of inflation for wage and price setting. That what people actually do is they have rules of thumb. If you ask people what's your number for the expected inflation rate, they probably don't really have that number, such a number. What they have is a pattern of behavior, and that pattern of behavior changed in the 70s as people began to behave as if we were going to be living in a 10% inflation economy for the foreseeable future. But we're looking; it's very squishy. And I'm also, the other thing I'm very curious to watch is to see whether the labor force participation starts to recover. We don't really know quite why that happened. And it clearly wasn't the incentive effects of unemployment benefits because those went away and nothing happened. But it might still be the cash cushion from the previous rescue programs. And if labor force participation really starts to recover, then I would say, well, then no, let's not hike. But it's going to be a very anxious, very knuckle-biting year or so.
Okay. On just quickly on supply constraints going away, are there particular indicators you look at or trust?
Well, labor force participation is the main one. I actually think that all of this other stuff, the container ships, the ports, that all, in some sense, should be part of the stuff you exclude from core inflation. Conceptually, core inflation is supposed to be stuff that isn't like that isn't moved by short-run fluctuations in supply and demand. And so I mean, I'm certainly hoping except to the extent that supply constraints might start to get built into some kind of wage price spiral. But I don't see that. But I really am not. I'm mostly actually looking at labor market, looking at labor force participation, to some extent compensation, although some of that is also. But so I'm looking at LFPR and ECI a lot, and feeling uneasy looking at them. But that's what I'm looking at.
Okay. Well, thanks very much, Paul. I think you can stick around for.
Yeah, I want to hear the panel for sure.
All right. Okay. Well, this was a very good exposition of Team Transitory's position. Let's go to Larry Ball. Larry, at least as of the middle of the year, I think you were on Team Transitory. You had a piece in Vox EU with Geeta Gopinath and others saying that the rise in US inflation will be modest and temporary based on Phillips curve estimates. So let me turn the floor over to you, Larry, and let's see where you are after almost six months of data. Over to you, Larry. I think you're muted.
How about that?
Yep.
Okay, great. I'm very happy to be here, although I winced when I saw the announcement with that quote from May about inflation being modest and transitory.
That was deliberate to get you, to provoke you into
because that article from May,
if you've changed your mind, yeah.
That article from May with some esteemed IMF colleagues has already been refuted. So specifically based on our analysis of the Phillips curve, we said that by 2023, the CPI inflation rate might get to 2.4%, based on, or the core CPI inflation rate is measured by the weighted median, 2.4%. Or if unemployment got all the way down below 2%, maybe core inflation will get up to 2.9%. And we already have inflation higher than that by any measure, much more quickly than we predicted, even though unemployment has been higher than we assumed. So we've been wrong about predicting what's going to happen to inflation. Now, having said that, if I can share my screen. All right, is the screen sharing working? It says connecting.
Uh-oh.
Let me try again. Yikes, do you have the slides there?
Not yet. Sometimes it takes a minute though. But
all right, well, maybe I'll start talking about the slide even if it's not up yet. What we said in May has not been so far off the truth up to this point, because we were talking about core inflation. I agree 100% with Paul that we need to look at some measure of core inflation that filters out some of the crazy things going on with ports and used cars and so on. And we believe the best measure for that purpose is weighted median inflation. And again, we're not seeing the slide, but weighted median inflation over last summer, I was still very firmly on team transitory, because even though headline inflation had gone up to high levels, and even excluding food and energy, the traditional core measure was up to high levels, weighted median was very benign up until just the last few months. The last few months it started rising, but still as of October, over 12 months, weighted median inflation for the CPI is 3.1%. So we're still a long way from the 1970s. And I wish we could see the slides.
you might want to try sharing again. I don't think it took.
Now I'm trying to click out and it's not letting me. It seems to be frozen.
Yeah. I think Daniel's going to try.
Oh, Daniel's going to save the day. Okay.
Yeah.
Okay. Thank you so much, Daniel. Okay. So yes. So there's the picture. So the blue line is weighted median monthly on the left and 12-month averages on the right. Again, it was not at all worrisome over the summer until just a couple months ago. And now it's just 3.1% on a 12-month basis. Now, having said that, the trend looks a little bit worrisome. It's getting steeper. And actually, the October number annualized was 7.1%. So if we continue to get monthly readings of annualized 7.1%, then we do have a problem. So basically, I'm going to have a sleepless night on December 9th because the CPI for November comes out on December 10th, and we'll see whether if median inflation is really cruising along at 7%, then there will be reason to worry. Now, this is a little bit puzzling because the labor market is not especially tight. If you measure labor market tightness the way we did in our May article with the unemployment rate. So Daniel, if you can go to the next slide. So this is updating a picture from the May piece, again, with IMF colleagues. So the blue dots are a scatter from before the pandemic of the inflation gap is inflation minus a measure of expected inflation. The unemployment gap is unemployment minus the CBO natural rate. And the blue line, the blue dots give us a downward sloping Phillips curve. And again, until recently, the red dots from the pandemic are within the scatter plots. But we see in the third quarter of this year, we're starting to diverge off to higher inflation. And then the fourth quarter at the top is quite alarming, with, of course, the obvious caveat, we haven't really seen the fourth quarter yet. The fourth quarter is really October, where we then assumed, suppose that median inflation in November and December is again 7.1%, as it was in October. Then we get an alarming increase in inflation, despite the unemployment rate being not especially low. So on the other hand, it could be the October numbers an anomaly. And again, we'll learn a lot from the next couple of CPI reports. Anyway, at this point, based on unemployment, we have a moderate puzzle in Q3, maybe heading towards a lot larger puzzle in Q4. Now, I'm sure a lot of the people listening sort of know what the next step is. As Paul pointed out, by many measures of the labor market, we have a very tight labor market. In particular, vacancies are very high. So Daniel, if you can go to the next slide, please. So there's been a striking shift in the beverage curve relating unemployment and job vacancies from the blue scatter plot before the pandemic to the red dots more recently. So there's been an outward shift of the beverage curve, which first showed up as very high unemployment with a normal level of vacancies. But now over the last year and a half, we've moved up this new beverage curve, and we now have normal looking unemployment, but very high vacancies. So in predicting inflation, if we think that vacancies matter as well as unemployment, we want a measure of slack that takes both into account. And one natural thing that a number of people have looked at as a measure of slack, which is pretty simple and intuitive, is just what's the ratio of the number of unemployed workers to the number of vacancies. So on the next slide, so this is a version of the Phillips curve plot where, again, the measure of slack is not the unemployment rate, it's unemployment relative to job openings or unemployment over vacancies. And there, basically all the way through the third quarter of 2021, what's happened is right in the middle of the scatter plot from before the pandemic. And we're to the left part of the graph, indicating a tight labor market. We do still get a troubling outlier in the fourth quarter if we think that if we think that November and December will be like October for the median inflation rate. So we may or may not in a couple of months have a really strong puzzle that even controlling, even using vacancies to measure the tightness of the labor market, and even using a measure of core inflation that tries to strip out the supply chain issues and so on, we still have higher inflation than one might think. Daniel, if you can go to the next slide. I might mention, by the way, and this I was a little surprised at, that if you just do simple Phillips curves, regressing median inflation on different measures of slack, this unemployment relative to vacancies variable actually does better in the sense of R squared than the unemployment rate. So we got an R squared of 0.665 with this new variable compared to about 0.5 with the unemployment rate, suggesting that going forward, when we measure slack, we should look at vacancies as well as unemployment. All right, just one more point. So I think Paul hit the nail on the head at the end that the key issue is what's going to happen to expectations. So presumably at some point, I was going to wait to show that for a minute dramatically, but that's, well, okay, that doesn't matter. So presumably the supply chain issues will get sorted out eventually. The labor market will normalize eventually. So if expected inflation is anchored at the Fed's target, then we'll have actual inflation go back down to the Fed's target. But the big question is what's going to happen to expectations. As Paul pointed out, it's difficult to measure inflation expectations. One measure that I like, and I think does well in explaining past inflation and fitting in a Phillips curve, which actually Paul didn't mention, is long-term expectations from the Survey of Professional Forecasters. So Daniel, you can now dramatically show that picture, please. We could discuss whether this is a good measure of expectations. I like it. And the story is before 2008, CPI, long-term inflation expectations, seemed anchored at right about 2.5%. And then expectations drifted down a little bit and then have risen sharply in the last 6 months. So there's a positive and negative way to read this. The optimistic way is that, as Paul said, after 2008, it looked like we were heading to a secular stagnation, zero bound, risk of deflation situation, and expectations were drifting downward, and that was dangerous. It could lead to a deflationary trap. The optimistic reading of recent history is that because of the Fed's aggressive actions and its new policy regime from last year about average inflation targeting, people have been reassured that we're not going to fall into a deflationary trap. And so expected inflation has come back up to about 2.5%, where it was before 2008. And we've overcome the fear of deflation. That's the positive explanation. The obvious negative story comes if you look not at the current level, but at the slope. If expected inflation is going up because of high inflation readings, and if high inflation readings continue for a while and expected inflation continues to go up steeply, then it really does look like we're de-anchoring on the upside and we have a big inflationary problem. So I will be very, very nervous in early January as we approach the release of the SPF inflation expectations for Q4 of this year. And if we start seeing 2.7, 2.8, 3.0 for long-term expectations, then I would get a lot more worried. And so on that inconclusive note, I will stop. Thank you very much.
Thanks very much, Larry. It's good to have your updated views, and let's hope for the best on December 10th. Paul, let me turn it back to you for any reactions to Larry's views, as well as a couple of questions in the chat. I think both questions in the chat are questioning a bit your assessment that BBB, Build Back Better, will not have much inflationary consequences. One questioner asking whether it is wise that couldn't budget neutral fiscal policy still be stimulative, and the other person noting that BBB is front loaded so that the implications for near-term inflation may be more potent than over the 10-year period that you were talking about.
Yeah, so on the front, it is true that it's somewhat front-loaded, but I don't. Unfortunately, I wish I had to hand, but Jared Bernstein just had a pretty good work through the whole thing, and it's not. The numbers are still a fraction of a percent of GDP. I'm pretty sure that it is front-loaded, but not that front-loaded. It's true that they're partly doing some I'm gonna say they're doing a little bit of making the numbers add up over 10 years by having the spending. There are things that everyone hopes will not happen, like pre-K financing expires after year 7, and so it does have front loading, but I don't think it makes the numbers all that big, even so. And it's probably worth pointing out that it's really BBB plus BIF. We have too many acronyms here, but it's the bipartisan infrastructure framework. And the infrastructure will not be all that front-loaded simply because infrastructure takes time to happen. So the actual, so the childcare stuff goes out the window pretty much immediately, but the roads and bridges actually only really start employing a lot of people a couple of years out. So I don't think that's that big deal. Yes, the balanced budget, the balanced budget multiplier is one of those things that I think you have to have been of a certain age to have actually had it taught to you. And it is true that
the questioner is a young woman, but yeah, she studied her history.
yes, yeah, okay. But I was going to say that what is true is that to the extent that this stuff is it's importantly paid for with taxes on high-income people. And if we think that they have a low marginal propensity to consume, then that's relatively ineffective at reducing demand. But that's kind of why I usually stress the spending numbers rather than the projected deficit impact. For what it's worth, to the extent that there's a corporate tax element here, although I don't think it's going to, everything suggests that will have very little impact on investment demand. It might have some impact on asset valuations, and that might have a faster effect. But come back to this, that when all is said and done, we're talking about in the vicinity of $2 trillion spread over multiple years, which is just not that, the sheer scale. I know that not this audience, but in public debate, there's a real Dr. Evil effect. You say $2 trillion, and it sounds like a very big thing, but relative to the scale of the beast that we're tackling, it's not that big.
Okay. And any reactions to Larry's temporary abandonment of Team Transitory?
Well, I mean, the way I think about it still is it's certainly true. I mean, I think we do need to acknowledge that inflation has run a lot hotter than Team Transitory thought it would. That we are really off off any kind of Phillips curve that you might have estimated based on previous experience. The reasons for that are, I think, I mean, there's the supply chain issues, which are presumably transitory when all is said and done, and then there's the labor market, the weirdness of the labor market, which is quite possibly much more sustained. But all of this comes back to, in the end, it comes back to what really matters. I mean, the 46-48 inflation was not transitory by any of the metrics that people use now. It went on for 2 years. It was it represented, it was genuine. It wasn't idiosyncratic, but it was in fact transitory because it didn't get embedded in expectations. And I mean, I like the idea of using the survey of professional forecasters, except the problem with that is that's a bunch of people who are just a lot like us. And so in a way, the SPF is measuring what people, I mean, I hesitate to figure out what's happening in the economy by looking at the opinions of people who are basically looking at the same data I am.
Okay. Well, thanks very much again, Larry and Paul. We are now going to sort of broaden the scope of this webinar. We've been talking almost exclusively about the US situation. We will keep the focus somewhat on advanced economy inflation, but bring in more of a global perspective. And Surjit Bhalla is going to lead off by giving us a bit of a review of how inflation was behaving in advanced as well as emerging markets prior to the pandemic, and his views based on recent work on which way inflation might go globally and the impacts of globalization on advanced country inflation. So over to you, Surjit. If you want to share your screen, don't try to share the screen, that's fine. If you have trouble, I think we have a backup lined up.
Okay, now let me try. Thank you, Prakash. And let me go to share. So let's find this one. Share. Let's see, it works. Yes. And now I'll expand this. Sorry, not that.
The slideshow, yeah.
Yeah, right at the...
No, not that. Yeah.
This one?
Yeah. No. Yeah.
Yeah. Okay. Thank you. Now, what I'm going to present is based on joint work with Prakash as well as with Karan Bhasin. And it is on the very topic that we are all discussing, which is whether the inflation that we have seen in the West and somewhat around the world, whether that is transitory or not. And the best lessons from the best lessons that we can learn are from looking at history. And we will end with where Paul Krugman started, which is and ended, which is the 46 to 48 inflation experience, whether that was transitory or not. But that's in the future a little bit. Let me just look at these data from 1960 to 2020 for advanced and for emerging economies. It's the median inflation rate. Now, two factors or two results come out somewhat starkly. First is that there has been an inflation decline everywhere around the world. Second, that the inflation today in the advanced countries is at, and if you take the 2.5% that Larry Ball was talking about, we have been at that level since about the mid-90s. And we may have just gone above it to be sure, but you know, this inflation decline and to a low level is not a recent phenomenon, especially in the advanced economies. It's a global phenomenon. So the question is, what happened over the last almost 3 decades? Let's make it 2.5 decades. And that's what we'll explore today and in subsequent. So let me, the first, and now, you know, often whenever you're talking about inflation, there is it a monetary phenomenon? And our results show that really to think this is a monetary phenomenon just doesn't fit any of the evidence or large part of the evidence. And we have, on the one hand, everybody has observed this reality of inflation declining, and the central bankers claim credit for better monetary management, especially inflation targeting and anchored expectations, and in part due to the spread of inflation targeting. And also, I might add, fewer policy mistakes, because all the central bankers and all of us have learned from the experience, so there are no policy mistakes. On the other side are structural factors at work. And demographics is one, which has been much talked about. Globalization, I think, captures a lot of the essence of what we have done research on and what we conclude. And it is that we have to pay particular attention to the impact of globalization in order to understand what has happened. Now, within globalization, there are two studies, one by myself, which is about the effects of unlimited supplies of skilled labor, which I'll turn to, and the others by Prakash, that basically increased mobility of capital has decreased the bargaining power of workers, and therefore you now have less wage pressures and therefore less inflation. So, you know, one of the and one way to look at the unlimited supplies of skilled labor, and I'll give you some startling statistics on that, is that it is like the Phillips curve in the sense of unemployment. So we're now looking at a global scale. If there are lots more of skilled workers and workers participating in the marketplace with lower productivity, then you will have an increasing productivity among them. And I should mention that a large part of our story on unlimited supplies of skilled labor is education. Education has spread, and there's one startling impact of the spread of inflation, or the accounting for the spread of education. In 1992, in the advanced countries, that's about 21 countries, the amount of workers who were, or amount of college graduates was 80 million. Okay? And the amount of college graduates, the flow, in 1992, the rest of the world was also 80 million. Today, in the advanced countries, the total flow of college graduates is 124. And in the rest of the world, it's as high as about 300. So we've had a massive expansion in the amounts of skilled labor that are there. And it is this that we think has, and this is like, if you will, I don't want to stretch the parallel too far about unemployment, but I do want to stretch the parallel about the links, the indirect links with the Phillips curve, that there really has been a phenomenal increase in the supply of labor, which has put the pressures down on inflation, on wage inflation. And remember, the wage inflation or inflation, according to the Phillips curve, is wages and unemployment, not the CPI or whatever, okay, or wage inflation. Now turn to what are some of the common cures for inflation that I talked about that have been attributed. Why have we observed this large decline in inflation? And what is the evidence? And we call it, is it vaccine or is it a placebo? Inflation targeting, that is. And we will now look at, in somewhat detail, on the evidence on inflation targeting across the world, across time, and across inflation targeting and non-inflation targeting countries. So first, in inflation in advanced economies, 2000 to 2009, 2010 to 2019, we observed a decline in inflation in advanced economies, but no difference in whether you were an inflation targeter official or not. Same story in the developing economies. Big decline in average inflation, no difference in whether you were an inflation targeter or not. Then the other explanation. So one, as I said, was, the central bankers became more proficient, adopted inflation targeting, and therefore you have a decline in inflation. The other very, very common, popular, I would say, explanation is that inflation expectations are well anchored, and somehow that has fed into this lack of expectations, and therefore that has fed into the process. Now, we look at inflation expectations in advanced economies and in developing economies, IT versus non-IT, and what you find that the non-IT ones in the advanced economies have had a lower average level of inflation expectations than the others, and the same story in developing economies, that there is no difference and there is a decline. Our results are very similar to Larry Ball and Sheridan's thing, to their results, and we find that similar results after extending their data through 2019, adding emerging markets, and doing synthetic control analysis, statistical tests, and structural break tests. No matter what you do, it turns out that the beneficial impact of inflation targeting is not apparent to the naked eye or even to the sophisticated eye. So now I want to turn to some of the policy mistakes that have happened throughout history. And I want to start with Alan Greenspan in 1995 raised interest rates by 50 basis points. And if you remember, and I had to reverse course in about a couple of years. But the point I want to emphasize here is that I gave you the previous data on 1992, where it was the college graduates emerging were equal in the two sets of economies, one much larger than the other. And, that's when the college expansion really took place. And therefore, what you have is that, that was the beginning of globalization. China had entered the scene in 1980, but by the mid-90s, it was a very, very pronounced appearance by China and Chinese goods, etc., and Chinese workers. And you also have then in further on, one other aspect which we haven't highlighted in the slides here, that oil prices have been, remember, that's how we all started talking about inflation back in the 70s, that oil prices in the international oil price was something like $10 a barrel in 1998, and in 2008 had reached a peak of $140 or $150 a barrel. And what happened during that time period? Inflation systematically went down. So didn't feed into expectations, didn't feed into rate hikes, or didn't feed into higher inflation. We then have the ECB hike rates in 2008, worried about impact of oil prices and inflation just at the peak in 2008. And it's not as if oil prices had contributed to that 1 year. So 2008 is another episode which corresponds to where we may be at today. This by commodities, not necessarily only oil prices. Incidentally, commodities were also at the forefront of the great inflation experience of the 70s because, and especially food prices, wheat and rice, and especially wheat, went up in 1973 because of a global drought, as it were. And you had a temporary blip up in food prices or in wheat prices, then you suddenly had the oil price hike, and we had entered into a new world. But oil prices do not make much of an impact now, and it's not at all clear whether the commodity prices have had lasting impact. Remember, if commodity prices go up, oil prices go up and wages don't, then that is another indication that it is temporary or transitory. Okay. Then the other major policy mistake that I want to emphasize here, that Indian GDP growth declined from something like 8% in 2016 to 4% in 2019. And what was the reason for that? It was that real policy rates in India in 2016 to 19 were the highest in the world, and something like 3% real to 4% real. And that may have had an impact. So we count that as another policy mistake. Okay, one last statistic on this, on the unlimited supplies of skilled labor, is what has happened to the growth in college premium in the US. And whether you look at men, women, or total, there has been a systematic decline in the growth of college premium. We are also working on what has happened to, and this is what I want to end on, that again in the 46 to 48 episode that Paul talked about, it was basically manufacturing goods that had caused the inflation, and services were lagging. Now, a large part of the world's output rather, is services. And we have unlimited supplies of skilled labor, which are feeding into a lower service inflation than otherwise would have been. So that, I think, in the share of services has gone up tremendously. There's a lot of labor in these services, and the labor is mostly from the developing countries where the wages are lower, real wages are lower, their productivity is going up. So this is what we might be seeing worldwide, is a massive convergence brought about by inflation, by rather education, and therefore convergence in productivity. The developing countries, large masses, increase their productivity. That puts a downward pressure on wages worldwide. I'll conclude that, and now back to you.
Thanks very much, Surjit. Paul, can I get a quick reaction? You're the expert on globalization. So I know this webinar is more about the here and now, but
Yeah.
if we get over these temporary hurdles, does what Surjit has sketched out resonate with you as possible future? Do you think globalization plays a role in keeping wage growth and through that inflation under check?
Actually, I'm going to say no. I don't actually buy the globalization story. I mean, I understand where people are coming from, but the way I would look at it is, first of all, we add, in effect, you can think of it, we add large supplies of labor to the pool, but we also add demand for labor to the pool by opening to the rest of the world. And at least in a macro sense, it's roughly a wash. I was just actually quickly looking here at the current account balance of emerging markets as a whole in recent years has been essentially zero. So it's really not as if there's any aggregate shift in demand that comes out of all this. It's just a bigger world, but it's not clear why things should be different. The one place where you might think there would be, I mean, there's an increase in the supply of skilled labor, but also in the supply of less skilled labor. I mean, there's some factor proportions issues, but I don't think that those have a systematic impact on inflation. The one thing you might say is that international competition might limit the market power of labor, but there the issue is I guess I would the caricature there is you think of, well, the auto workers used to be able to set wages, and now there's a global market in auto, so they can. That's true, but the great bulk of employment in all countries is non-traded, and certainly I different issue we talk about sometimes, but for the U.S. a lot of people think, well, the decline of unionization was inevitable given globalization and all that, except that the Nordic countries face the same global economy that the U.S. does, and they have 2/3 of their workers are union members, and it's just if you want to ask the story about the United States, you want to ask why when first Walmart and then Amazon became major employers, they did not get unionized the way General Motors had been, and that's not a globalization story. But the demography, I think, is hugely. I mean, I think that the reason that we're in a world of persistently weak aggregate demand is, I mean, there is some argument about this as there ought to be, but I still think that the best story about secular stagnation is still Alvin Hansen's story from 1938. It's with a flat or declining working age population, investment demand is weak, and that in turn, I mean, it's in some ways it's easy for central banks to pursue relatively tight monetary policies when they don't realize they're pursuing relatively tight monetary policies because the R* has dropped, and I think that is in many ways it's a bigger factor. The idea that it was because we all learned the lessons and created independent central bankers. Well, that's a little bit of but I thought it was impressive. There is really essentially no empirical evidence for that, and the reality is probably that we just got a world where it became a lot. The world basically had a disinflationary logic to it. So I mean, I'd be curious to have a discussion at some point about the globalization story. I don't think the way that it's often framed. I think it's often framed in a kind of partial equilibrium way. You think that, well, there's increased competition and that restrains inflation, but that's not at all clear that actually works once you start to take into account demand as well as supply.
All right. Thanks very much for that reaction. Clearly a conversation to be continued. Surjit, I wish I had time to give you a chance to respond, but unfortunately we're running out of time. And as Paul said, this is a bigger discussion that we can have. So let's turn the floor now to Sonali Das. She is the IMF's research department and was a co-author on the chapter in the World Economic Outlook in October 2021 on inflation, and at least that at that time they came to the view that long-term inflation expectations remain anchored, and headline inflation is expected to return to pre-pandemic levels by mid-2022 for most economies. But of course, again, things have changed since the WEO was put to bed in September or early October, whenever it was. And so let's turn to Sonali, both for any updated views and also the kind of the logic and the reasoning that went into the inflation chapter. So over to you, Sonali. We're running a little late, so I'll tell people that we may go 5 to 7 minutes over. Go ahead, please.
Prakash, I'll try to shorten a little as well. So yes, my remarks are based on this analytical chapter of the October World Economic Outlook titled Inflation Scares, where we explored the prospects for inflation across countries in depth. So I have slides that hopefully you can see here. So I'll kind of take you through our logic for October and might address updates at the end. So just to set the stage, so this increase in inflation since the start of the year has been global. This chart shows the blue and red lines are showing advanced and emerging market economies, that headline inflation has risen and to a lesser extent core inflation has risen. And the yellow line is headline inflation in developing countries, developing economies, which has been increasing somewhat as well. So as we've kind of touched upon already, the inflationary pressure has been driven by pent-up demand, including that shift in the composition of demand to goods, supply chain disruptions preventing supply from meeting this demand, and also sharp increases in commodity prices. So in olive oil, metals, and food as well. There have been significant surges in the prices of staple foods in several developing economies. So we also start the chapter with an estimation of the Phillips curve for about 50 advanced and emerging market economies. And I won't get into the details here in the interest of time, but basically what it suggested in combination with the IMF projections of the unemployment gaps from 2021 to 2026 is that the inflationary impulses from demand stimulus are likely to be moderate going forward, and that the demand contribution to inflation that we implied from these Phillips curve coefficients is relatively small. So the figure shows it here for these years for advanced economies, and it's similar for emerging markets, just slightly larger. But the main point is, of course, there's a great amount of uncertainty than usual. So for example, about how COVID has affected potential output, that we've discussed that a little bit, and where we are in the recovery. And there are also significant differences across countries. So the US drives a lot of the short-term demand contribution to inflation pictured in the chart here. So the pandemic and lockdowns have led to large supply chain disruptions that we've discussed and large and visible sectoral price swings. So we thought it's useful to compare this to the past. So the left-hand chart here shows sectoral inflation dispersion for a large group of countries over time. So it's about 50 countries. So by dispersion, we mean the weighted standard deviation of sectoral price change. So it's a monthly measure. The blue line shows the average, and then there's the interquartile range. So somewhat surprisingly, the overall sectoral dispersion, price dispersion so far it's not as high or unprecedented as expected in this COVID period compared to the past. So you can see why on the right-hand chart, basically you see that swings in fuel, food, and especially housing prices this time have been smaller and shorter lived compared to, say, the global financial crisis. And these are the three largest components of consumption baskets on average across the countries in the sample. All of that said, though, it's not clear how long it will take for the supply disruptions to clear. And of course, large movements in visible prices, such as fuel, could affect inflation expectations. So we analyzed the risks from continued sectoral price movements and commodity pressures in certain scenarios, which I'll come to on the next slide. As background, and as Prakash mentioned, in the IMS forecast for inflation that were presented in the October World Economic Outlook, the baseline projection is that across most economies, inflation is expected to come down to its pre-pandemic range in 2022, essentially once supply and demand mismatch is resolved. In some emerging market and developing economies, however, inflation is expected to stay elevated into 2022 due to lag passed through to broader inflation from higher food and oil prices, so essentially from the importing countries for those commodities. Now, I mentioned there's a lot of uncertainty around this baseline, and as discussed in October, the risks are tilted to the upside. And so in this analytical chapter, we had done work to help inform the risks, essentially. So what I'm showing is here is we used quantile structural vector autoregressions for about 50 countries to illustrate two possible tail risk scenarios. So the specification includes global commodity prices, sectoral inflation dispersion that we just discussed on the last slide, 3-year ahead inflation expectations, so that's from professional forecasters, inflation itself, as well as other variables. So on the left-hand side here first, it's a scenario with continued strong increases in commodity prices and sectoral inflation dispersion over the next 12 months. So basically seeing if these supply disruptions persist and what will happen. In the left two panels, you see that headline inflation would spike up significantly, peaking at 4.5% on average in advanced economies in early 2022, and over 18% in emerging markets and developing economies. But one thing to note, the important thing is even in this extreme scenario, inflation goes back to trend by early 2024. And inflation expectations remain anchored. So given the concern about expectations de-anchoring and having kind of a self-fulfilling inflation spiral, we extended the scenario to allow for inflation expectations to become adapted for 12 months. So that means they no longer are forward-looking or anchored on central bank targets, but instead they're reacting to incoming data about inflation. So you can see the results on the right-hand chart, which is where you see that inflation then increases substantially and becomes more persistent and volatile. Basically, what the scenarios show is that continued sectoral disruptions in commodity price pressures would likely lead to higher peaks and a delayed return to trend. But in the medium term, the outlook would still be driven by fundamentals. And the real concern is if we have a de-anchoring of inflation expectations, and that would have serious implications. So I'll try to keep this short since we're essentially at time. So we then tried to kind of shed light on the risks of expectations de-anchoring. And so first, we looked at past episodes where inflation accelerated to a high level, so inflation scares. And just to note, these are not hyperinflations, but 55 episodes of high inflation in about 40 countries between the late 1990s and just before the pandemic. And in emerging markets, these episodes were often associated with large exchange rate depreciations, not surprisingly, and preceded by a widening of fiscal and current account deficits. In these episodes, near and medium-term inflation expectations rose, and they rose more in the more persistent inflation episodes. And this underscores how longer spells of high inflation can start to feed into expectations, even in countries where they were anchored to start. So then we also connected case studies for several of the episodes. So in Brazil, Chile, India, and also the US 70s episode that we've discussed, to better understand the policy response and how that interacted with expectations and inflation. And one lesson was that strong policy action was often needed to bring down inflation expectations, And these actions were more credible when reinforced by clear and particularly state contingent communication from central banks. So this is kind of, it's more of a concern for emerging markets, even though inflation expectations have become more anchored in the past 2 decades. There can be more of a need for actual action to maintain that credibility in the face of pressures. The case studies also showed that longer-term expenditure commitments could be associated with unhinged expectations, underscoring the importance of credible medium-term fiscal frameworks. So we also looked at market-based expectations, how they've evolved during the pandemic, and that's where the conclusion really that medium and long-term expectations have stayed anchored so far comes from. Like Professor Krugman mentioned, we don't have the data we would want on workers' expectations in the US, other advanced economies, let alone emerging markets. In many emerging markets and developing economies, we don't even have the professional forecaster surveys kind of reliable series. So essentially, the thing that we have to monitor the best we can with the data we have is how inflation expectations are evolving. So that's essentially it in terms of policy implications. It's clearly a challenging time for policymakers. So they need to walk a tightrope between acting patiently to support the recovery and at the same time preparing to act quickly if inflation expectations show signs of de-anchoring. But clear and state contingent forward guidance and communication are key to help avoid taper tantrum-like scenarios as advanced economies central banks normalize policy. And the case studies also show that strong fiscal credibility is important and that it affects inflation anchoring. So thank you very much. That's kind of essentially how we see the risks.
Thanks. That's very useful. I know we are out of time, and I know Larry has to go off to teach. I'll give everyone 2 minutes, Larry and then Surjit, and then final word to Paul. Any last reactions to this session, and anything you want to add, Larry? Larry, you're muted. I still can't hear you. Well, okay. Well, you're off to teach. Thanks very much for coming, and we'll spend a sleepless night with you on December 9th and hope for the best. Surjit, 2 minutes. I promise you a longer debate with Paul on globalization and inflation later. But
I think I will need less than 2 minutes. I think one of the empirical questions we need to assess is what is the share of non-tradables in the world today, and if that share is going down, then the international wage pressures suppressing inflation. So I think a lot of, for example, banking, telecommunications, railways. In India, they have constructed synthetic indices for the last 10 years, and obviously, because we know what has happened to the prices of these goods, they are going down. So I think the share of services in the world is going up, and that may be accounting for, and that's what the parallel was with 1946 to 48. It's a reverse, that the share of manufacturing went up, their prices went up, and now we may be seeing and have been seeing for a long time exactly in reverse. And that's the connection with globalization. But thanks.
Okay. Paul, the last word to you. Any last thoughts on everything you heard and your own position?
Yeah. So I'm okay. I'd love to have that discussion about globalization, and we could, but not now. I mean, the big question now really is still, well, sorry, 2 questions. I'm going to turn into a Monty Python routine if I go any longer. But 2 questions. One is whether these, the clearly we're now in a situation where, at least for the moment, we really do have excess demand. We do have demand pull inflation, but it's odd because it's a demand pull inflation because supply is much more constrained than we thought. And there's an immediate sort of, immediate meaning roughly 6 months to a year of whether those pressures fade. And there's huge uncertainty really about what's going to be happening to aggregate demand. How much is there a delayed impact of fiscal measures that were taken in early 2021? How much is it really all behind us? And so if you just look at the quarter by quarter fiscal impact, we're headed for a major fiscal contraction right now, but is that the right measure? And then there's this deep mystery of expectations. Just want to say that when all is said and done, we really don't know a whole lot about what drives expectations. We have macro fitted Phillips curves that used to basically use 1 year lagged inflation or something like that. But I was strongly, I'm sorry, shouldn't be reading, but if you look at the Nakamura and Steinson stuff that uses state level stuff, they end up concluding that what happened in the 80s wasn't the story that many of us tell, where a sustained recession brought it down. It was instead something about the people recognizing the steely resolve of Paul Volcker. I don't think I believe that, but the work is solid. And so there's a lot of uncertainty. And I think we just need to keep an eye out for what's happening. I still am, in terms of balance of risks, I think we should behave as if Team Transitory is still the best bet, but we could easily be wrong.
All right. Well, on that note, thank you all for participating. And Paul, we'll watch out for your tweets on December 10th to calibrate our own positions here at the fund. Thanks very much for coming. All right. Thank you all. And sorry to run a bit long. Bye-bye.